Now we get into valuing. So we've done our accounting. We know how to make adjustments to our financials so that they reflect what we believe to be the future. We learned how to forecast the future, line item by line item. On Friday we talked about how to establish an equity cost of capital using the capital asset pricing model. Now we'll learn how to value a company, and we're going to learn in two different ways for each of the valuation methods. You learn how to value an entire company from the perspective of, if you're going to do an acquisition, what's the value of all the assets in the company? And in that case, we're going to use the weighted average cost of capital. And then we're going to value a company from a shareholder perspective. What's the right price that you should have? What's the correct price for a share of stock? You would just use the equity cost of capital in that case. So we'll talk, as we talk about each of these valuation methods, we'll talk about them from the weighted average perspective and just the equity perspective. For the most part, what you'll be doing as you look at it from an equity analyst perspective is just the equity cost of capital. What's the proper value of a share of stock? And that's that. So, as we said, there are three different ways to value a company, all of them very closely related. We'll talk about the dividend-based valuation model here. Dividends represent the distribution of wealth to shareholders. This is the true distribution of wealth to shareholders. When you buy a share of stock, it's worth nothing to you if you don't get anything back. Dividends are what you get back until you sell the share. And the markets trust that you'll get some value back if you sell the share, which is why stocks go up and down irregardless of dividends. How many of you, I think I asked you to raise your hands last time, and almost everyone's taken a finance course somewhat recently. How many of you talked about Modigliani and Miller in your finance course? Two people, Modigliani and Miller. A couple of you remember the name? They were two young professors in the early 60s at Carnegie Mellon College near Pittsburgh. And they were teaching finance, and they were looking for a good finance book, and they couldn't find one, so they thought they'd write one. And they came up with their theories of finance, which I think, from my perspective, make a ton of sense. Two theories: financial leverage doesn't matter, and dividend policy doesn't matter. Essentially, the two cornerstones of their theories. In a pure world, neither of them matter. Whether a company pays or doesn't pay dividends shouldn't affect the value of that company to you, and no matter how much financial leverage they use, up until a tipping point, doesn't matter. The theory being, with financial leverage, you increase your risk, but it's okay because you increase your return in the same way you increase the risk. But then there's that tipping point where you've increased the risk so much that you now have a bankruptcy risk that's very high, and that's where the value is bad. But up until that point, it doesn't matter what your financial leverage is to investors. Investors would be indifferent, or should be indifferent. Similarly with dividends, when you pay a dividend, every dollar dividend you pay is $1 less in the company, and so the value of the company goes down, and investors should be indifferent to whether they get dividends or not, according to Modigliani and Miller. Now, that's all very true. Let's stick with dividends, because that's what's relevant here. Except there are a couple of things that make it imperfect. There are certain classes of investors that either like or need dividends. People who are on a fixed income who are using those dividends as a means of living day to day. They could just as easily sell a share of stock and not change their value and have the effect of a dividend. But that feels wrong. So dividends are a way to give people who are on a fixed income capital. Secondly, there are shares of investor or classes of investors, trusts, things of that nature, that are only allowed to invest in stocks that pay dividends by law, by rule. And in theory, that is a more risk-averse investment strategy. So dividends open up new investment vehicles. On the other side of the equation with dividends, it's not good for the investor because it moves your tax payments forward and you pay at a higher rate than on the capital gain. So when you get a dividend, you're actually disadvantaging the investor with a dividend. So the decision to pay dividends is somewhat arbitrary. It's up to the company. Ultimately, they want to say, can I invest this money better than my investors can invest the money? If a company believes that they can use that money better than you, and if you trust the company to do it, you'd rather that they didn't pay dividends. You'd rather they kept the money and they invested it in their own growth. So when we're using dividends to value a company, the problem is some companies don't pay dividends, or they pay very low dividends. They're retaining more earnings. And so how are we going to be able to value a company in that kind of a world? The other thing here, just getting back to the slide, dividend payments include all cash flows, not just what we think of purely as a dividend. So it's the quarterly dividend. Most times dividends are quarterly, but they could be annually or special, semi-annually or special. Microsoft a few years ago paid a $15 per share dividend just because they had all this cash they had to get rid of. They couldn't figure out how to use it anymore. But dividends also include stock buybacks, right? You're giving money to your investors, your common shareholder investors with a stock buyback. There's this liquidating dividend. So if a company were to go out of business and they paid off all their creditors, they paid off all their preferred stockholders, whatever's left gets divided among the common shareholders. That's the liquidating dividend. If a company issues new shares, which has the effect of diluting the value of the existing shares that are out, that's a negative dividend to the current investors because it dilutes their value in the company. So all of these things combined are viewed as are all viewed as dividends. So why do we use dividends as a means of valuing a company? Because it reflects the money that is given to shareholders. That's all that matters. At the end of the day, it's all that matters. It's the reason a company exists. The best example of that is an accounting partnership, any partnership. They spend their money, they do the things they need to do in the course of a year. At the end of the year, there's money left over. The partners share in that wealth. They're the shareholders. And so those of you who are looking to go into public accounting, you're looking to become one of those partners and share in the wealth at the end of each year. The reason we think of cash is because cash is the common currency of the world, right? It allows you to compare stocks to bonds to real estate to all other kinds of investments. So we talk about cash as we talk about value. But, as I said, dividends are arbitrary. They don't necessarily grow proportionally to performance. Some companies have slow growth dividends. Some companies keep their dividends relatively flat. If a company has a bad year, it's rare that they'll cut the dividend, because cutting a dividend tells the market a very strong message. And so you try to avoid cutting a dividend if you can. And because we know that companies don't pay out all of their earnings in dividends, there's this accumulating, liquidating dividend at the end that you have to somehow account for when you value a company. And it's a very important concept. So one of the questions we'll ask, but we're going to ask it only once, is when you figure out a value of a company and you're thinking about dividend growth, you're thinking about the cost of capital, do we take inflation into consideration? The answer is it doesn't matter as long as you're consistent, therefore you don't need to think about it. So we will essentially be taking inflation into consideration. Our cost of capital of whatever it's going to be, 8%, 9%, whatever it is, that considers inflation, or doesn't, as will what we're doing. It does consider inflation, as your forecasts will consider inflation. Because as you look at your historical growth, that has inflation built in, and as you forecast forward off of that historical growth, that's going to have inflation built in. But it's okay because you're dividing by something that factors in inflation as well. So it's a non-issue. So here's the dividend valuation model. The value of a company today, V sub 0, is equal to the sum of the dividend payments discounted back for perpetuity from year one forever. It's the sum of those dividend payments discounted back to today. That's the dividend valuation model. Another way of looking at it is it's each year's dividend discounted back. And how many years are we going to forecast? 5. So it's 5 years discounted back. And then something that you have to figure out at the end of those 5 years. This continuing value or liquidating value, whatever you want to call it. And we'll talk about that as well. This is that value at the end of the year. This is how you get your perpetual growth after the 5th year. I don't want to focus on this at the moment. We'll focus on it in 5 minutes. So as I said, these are the dividend flows for each of the years that we've done our forecasts on. This continuing dividend in year 6 and beyond, it's a function of your net income, a steady state growth rate, and that's important, a steady state growth rate. Now all the companies you're working on have been around for a while, so you can kind of calculate it, assume a steady state growth rate after a certain period of time. It's dangerous to do that for a company that's still relatively young in its growth cycle, which is why you want to forecast further into the future. And then the book value of the shareholder equity. Again, we'll talk about that in a moment. So the forecast horizons for perpetuity, generally speaking, it's from 5 to 10 years. We're going to do 5. And that 5 to 10 year forecasting horizon is based upon the maturity of the firm and the industry. The less mature, the further out you want to try to forecast because you don't know what the steady state is going to be. So that involves, what's the expected future growth and stability of that company, that industry. The challenge is the further out you forecast, the more you're guessing. But if you don't forecast and you're just assuming a steady state, that's also a guess. So you get one guess versus another as you're looking far into the future. Okay, so as we measure our dividends, we said dividends are whatever actual payment is made, quarterly, annual. If any of your companies, I don't think they have, but if any of your companies had a special dividend, be careful because that's not going to happen every year. I don't think that's happened in anything, not that I know of. So it's that plus net cash that goes to your shareholders through repurchase of stock, minus cash that's taken from your shareholders by issuing more stocks, which dilutes the existing shareholders' value.
that's just for like 1 year.
This last one?
Yeah.
That's just for 1 year.
Like the 1 year you're looking at.
Yeah, so it's at that point, the point of that year.
Time,
Yeah, at that point in time. Okay? So that's the calculated dividends. But as you'll see, we're going to figure out a different way to calculate dividends. We're going to do it with something called clean surplus accounting. And we're just going to use very simple algebraic stuff to figure out dividends. Okay? First of all, we think about all income, including other comprehensive income, as we think about what our net income is. So you take net income, including other comprehensive income. You include all the transactions, between the firm and common shareholders in this, and you can say, I mean, this says that your book value right now, this year, is equal to last year's book value plus your net income minus your dividend payments, right? That's a common accounting thing. There's nothing there. So we just spin it and say dividends are equal to your net income plus last year's book value minus this year's book value. Basic accounting rule, just looking at it from the point of view of dividends. We'll need to calculate the continuing value. If the company is going out of business, then you don't need it. It should be a positive number. It doesn't have to be. Remember, so after 5 years, we need to calculate your continuing value. That's the key number that you need to figure out to do that is this long-term growth rate called G. Long-term growth. And you use that long-term growth rate rather than having forecast all the individual line items. Just really assuming long-term growth of X%. It assumes that all your assets and liabilities are all going to grow in tandem after that point. Generally speaking, your long-term growth rate should be between 3 and 5%.
You can use that if you're like forecasting like revenues, just like use that growth rate and just carry it through to every.
We use this. We don't use this to do your forecasts. You're using this to calculate the continuing value after the horizon when you stop forecasting. Right? You forecast 5 years.
Yeah.
You've done that. You've done all that detailed stuff that we talked about on Friday. This doesn't replace that.
So why do you need to do this then?
Because you're only doing it for 5 years. There's still value in the company after 5 years. You just don't want to keep forecasting for perpetuity, right?
Okay.
Your companies are not going out of business. They'll have value 6 years from now, and 7 years from now, and 8 years, and 20 years from now, hopefully. And so we're doing this simplified model further out, which you can do because the further out you go from today, the less each year matters towards the present value. Right? The further away the cash flow, the less it matters today. And so we're saying 6 years out and more, we're just going to approximate. We're not trying to be exact anymore. And generally speaking, and you all have the right to change this, just support your assumption, you would have 3 to 5%. But if you're in a steady state and you're growing at 7% a year, and you believe that's going to persist, keep it. So, remember that formula we had before where we just took dividends. The dividend in year T was equal to the net income in year T plus the book value in T minus 1 minus book value in year T. This just takes it for the next year. The the dividend in year t plus 1 is equal to the net income for that year, plus the book value from the previous year minus the book value of that. Okay? To calculate the net income in year t plus 1, because we haven't done the detailed analysis, think of this as the dividend in year 6, 6, 5, 6. We've done the detailed analysis only through 5. The net income in year 6 is equal to the net income in year 5 plus 1 plus the times 1 plus the growth rate. So if the growth rate is 0.03, you would just take the net income which you have forecast for year 5 and multiply it by 1.03.
For our presentation, how many years out are we supposed to do this for then?
You just do this once. Of course,
So
there's a very simple way to take what you calculated in year 6 and make it go for perpetuity.
Okay, so
It's
this
sim-
is
it's
just
simple.
for year 6.
You just have to figure this out for year 6,
Okay.
and then you use the perpetuity factor to take it out forever. Okay? And that's going to plug it in more. So you find out your net income for year 6. You add in the book value that you already know for year 5, and you subtract out the book value for year 6, which is just the book value for year 5 times that same 1.03. Or whatever you do. So notice, we're not calculating the dividend in year 6 as the dividend in year 5 times 1.03. We're calculating for all these other factors, and that will give you your dividend in year 6. So that's the continuing value. So now you have 2 other calculations. You now have this thing in year 6. The first thing you need to do is to make it perpetual. And all you do is you divide it, this dividend that you just calculated, by your required rate of return on equity minus your growth rate. So if your required rate of return on equity is 0.07 minus 0.03, that would give you 0.04. So whatever the dividend is divided by 0.04 makes it perpetual. So that's the way you create the dividend from year 6 through eternity. But now we have it as of year 6, so you need to discount it back by the same way we always discount 1 plus the required rate of return to the 10th power. So in this case, the 5th power. So all in all, this is what it looks like, this continuing factor. It looks harder than it really is. It really does. Let me get to it. And one more thing, because it's never enough, right? This calculates it for the beginning of the year. You need a mid-year adjustment. So you just multiply it by a factor of 1 plus 1/2 the required rate of return. So the required rate of return was 0.07. You just multiply it by 1 plus 0.35. And that takes it from the beginning of the year to the middle of the year, which is a more reasonable. So you have to put in a mid-year factor.
1 plus the required.
1 plus 1/2 of the required return. So a lot on here. If you want to follow along on page 843, I thought we'd look at it from Pepsi's perspective. Everybody have a book near them or not? Let's work with me. So we've, through our detailed forecasting, or somebody's detailed forecasting, you have forecasts from years 1 through 5 for dividends. You then discount them back, right? That's the first part. Discounting those 5 years of dividends that you calculated through detailed analysis, and you discount those back. And that's this 16 billion, I don't even know what it is. It's gotta be billion. That gives a value for the next 5 years of dividends of $16 billion, 16.7. Now we need to calculate the continuing dividend for Pepsi using our formula. You take the net income from year 5, a growth rate of 3%, so it's 1.03. You take the book value from year 5, and you subtract out the book value for year 6. That gives you a continuing dividend of $5.2 million. Pepsi's required rate of return is 7.75 and a growth rate of 3%. Growth rate should never be more than the required rate of return. One, it destroys the math. But more importantly, if you're growing faster than your shareholders demand, they ought to be demanding a higher amount of money. So it just doesn't make sense intuitively that growth can ever be more than the required rate of return. So this continuing value is your dividend in year 6, which we've just calculated, multiplied by 1 over your required rate of return minus your growth rate. This is the perpetual factor. This takes this number and makes it perpetual for eternity. And then you, again, multiply by 1 over 1 plus your required rate of return discounted back. That makes your Pepsi's continuing value, $75.9 billion. Or $75 trillion. $75 trillion. You would then add that to the value that's attributed to the first 5 years. That's $92 billion. You do the mid-year adjustment. $96 billion. Then divide by the number of shares outstanding, and you come up with the value per share. This is how valuation works. So using the dividend model for Pepsi, it says the stock should be trading at $57.36 a share.
That brings it back to current?
Yes. Current. Yes. Today. And you look at the stock price. You either believe what you've done or not, and you have to be careful believing it. And then you can have a buy or a sell signal for yourself. Or a hold. Buy, sell, or hold. Notice how this continuing value is dwarfing the next 5 years for Pepsi. Okay, the advantages of using the dividend valuation model versus other models, the other equity models. One, it's the most pure way to calculate things. It's about the money being paid to shareholders, and that's what it's all about. It should reflect all of the analysts' expectations for the future, at least for the next 5 years. A disadvantage is very sensitive to assumptions. Your discount rate assumptions, which you're all going to have to make, and I've already had questions, what's the right answer? And the answer is whatever you say. There is no right answer. Just support support whatever it is. That discount rate has a big factor. Your assumed growth rate has an important factor. All your forecasts. It's a lot of sensitivity. And ultimately, as we just said, dividends are at management's discretion. So to the extent that they pay very little dividends, this model doesn't make a whole lot of sense. If they pay no dividends, then everything is in the continuing value. The dividends leading up to the, and so you're really going to have not a very strong basis for analysis. Sensitivity analysis, and you'll see it. I don't think we'll see it today. Maybe this afternoon, but if not, certainly Wednesday morning. How you might want to consider doing sensitivity analysis. You can't be too comfortable with your results. So what you want to do is essentially create a matrix of results. What if my growth rate was 3%, 4%, 5%? Or 3%, 3.5%, 4%, 4.5%, 5%? What if my discount rate was 5%, 5.5%, 6, 6.5%, 7, 7.5%, 8, 8.5%, 9? Visualize that matrix. Come up with your valuations for all the values in that matrix. See what the valuation of the stock price is. And if clearly across the range of reasonable numbers, it's a signal to buy or sell, then you have something. If it's confused, then you know what, you don't have it.